Firefly Aerospace, ticker FLY, delivered a massive top-line beat for their second quarter of 2026, reporting a record Q2 revenue of $117.7 million.
Which is actually the very first time they've ever broken the $100 million mark in a single quarter.
Yeah, exactly. I mean, it represents a 659% year-over-year increase and a 45.5% sequential jump from Q1.
Right, which just absolutely crushed the consensus estimate. I think Wall Street was sitting right around 89 million.
They were, yeah. But EPS was a miss against some street models.
Sure.
They came in at an adjusted net loss of negative 42 cents per share.
Which translates to a GAAP net loss of $92.3 million.
Right. But despite that bottom line miss, management reaffirmed their full year 2026 revenue guidance of $420 million to $450 million.
And the market reaction to all this was immediate.
Oh, totally. Shares closed up 2.3% in regular trading, and then they jumped an additional 4.8% in after hours to hit $27.62.
Which is a total daily swing of over 7%.
Yeah. Okay, so let's unpack this. How does a company grow revenue by nearly 660%, still post a $92 million GAAP loss, and have Wall Street cheering?
Well, to really get that, you have to point straight to the segment breakdown.
Right.
Because the headline revenue number, it kind of masks this fundamental shift in Firefly's entire business model.
Yeah, if you look at that $117.7 million total launch revenue the actual physical firing of rockets into orbit, that accounted for just $9.4 million.
Right. Just a fraction.
The remaining $108.3 million came entirely from their Spacecraft Solutions division.
Exactly. Spacecraft Solutions is now driving 92% of their total revenue.
Wow.
And what's fascinating here is that Firefly is rapidly transitioning from a really volatile, event-driven launch provider into this highly recurring, milestone-driven spacecraft and defense services platform.
It's like, imagine a company that originally planned to run a super risky taxi service.
Okay, yeah.
Like they were launching rockets to drop off satellites. That's the taxi.
Right, the event-driven model.
Exactly. But then they realized the real predictable money isn't in driving the taxi at all.
No, it's in building specialized cars.
Yes. Bidding the specialized vehicles and the navigation software for high-paying enterprise clients.
Which changes their entire risk profile. Because launching rockets, I mean, that's a binary event.
It works or it doesn't.
Right. The rocket reaches orbit or it's in the ocean. And your revenue is totally at the mercy of weather delays or technical scrubs.
But with Spacecraft Solutions, it's so much more stable.
Exactly. It's milestone driven. They hit an engineering phase, they get paid. They validate some software, they get paid.
Which gives retail investors incredible visibility.
Unbelievable visibility. CFO Darren Ma noted their contracted backlog just hit a record $1.5 billion.
$1.5 billion?
Yeah, and 95% of the midpoint of their 2026 revenue guidance is already booked.
Wait, really? 95%?
Yes, so going into the second half of the year, it's virtually locked in.
Okay, I hear the argument for the top-line visibility, but let's look at the bottom-line reality here. Because if 95% of H2 revenue is secured, why is the cash burn still so intense?
Well,
I mean, Q2 gross profit was $23.9 million.
Right.
But free cash flow was an outflow of $106.3 million.
Right.
Operating expenses hit $119.1 million, and $71.5 million of that was just R&D.
Yeah, the adjusted EBITDA was a loss of $61.2 million.
Exactly.
Yeah.
So what does this all mean for retail investors? Should you view this cash bleed as a red flag of capital destruction? Or is this just the necessary CapEx moat to become a top-tier defense prime?
It's definitely the latter. This is a classic aerospace scaling phase.
Okay.
The heavy cash burn you're seeing is tied directly to physical hard assets. They're doing massive test stand upgrades for the Alpha Block II rocket, and they are hugely expanding their manufacturing capacity down at their rocket ranch in Texas.
Because they have to actually build the hardware for that $1.5 billion backlog.
Exactly. You can't just manifest these spacecraft out of thin air. You need the infrastructure. Plus, a chunk of that capital went towards strategic M&A.
Oh, right, the Space Ring acquisition.
Yes, which was a brilliant move.
It's an AI company, right?
Yeah, they brought in 15 software engineers who specialize in AI-powered vision navigation technology. And it was essentially a cost-neutral acquisition for Firefly.
Why is that vision tech so critical?
Because of the Blue Ghost lunar landers. When you land on the moon, there's a communication delay. You can't just joystick the lander from Earth.
Right, you'd crash before the signal even reached it.
Exactly. So the lander needs AI vision to look at the lunar surface, identify craters, calculate slopes, and adjust its thrusters in real time.
Wow.
By bringing SpaceSkin in-house, Firefly vertically integrates that tech. They own it now.
So they capture the margin instead of paying a third party.
Precisely.
But still, with all this spending, I mean, the liquidity risk.
Actually, the balance sheet is a fortress right now for a company their size.
Really?
Yeah, they ended Q2 with $459.8 million in cash and cash equivalents, plus $175.4 million in short-term investments.
Okay, so that's over $630 million in liquidity.
And total debt has been drastically reduced to just $27.2 million.
Oh, wow.
Plus, they have a $305 million credit facility that is completely undrawn.
Okay, so they have the runway to absorb this burn.
Absolutely. The capital is being spent to fulfill massive new contracts because institutional demand is off the charts.
Yeah, CEO Jason Kim even said on the call that launch demand in the industry right now is the most constrained he's ever seen.
Right. Everyone needs hardware and a ride to space, and there just isn't enough capacity.
So let's talk about those specific contract wins driving the backlog.
Let's do it.
Because they just locked in a $144 million NASA CLPS contract.
Yeah, for Rapid Blue Ghost lunar mission. That's actually their 6th lunar mission contracted so far.
Which is huge.
Yeah.
And then they have the $75 million NASA JPL subcontract for the Moonfall mission.
Right, using their Elytra spacecraft.
And Elytra is basically a space tech, right?
Yeah, an orbital transfer vehicle. It moves payloads around once they're already in space.
They've got the moon covered. But what about defense?
Well, they just won a $94 million U.S. Space Force contract.
For the ground-based radar digitization.
Exactly.
Plus, they have all this momentum for their SciTech Forge software platform.
Which is basically AI-driven data analytics for missile warning and tracking.
Okay, so if we connect this to the bigger picture... Oh, wait, let me use your catchphrase there.
I'll allow it.
Yeah.
But seriously, if we connect this to the bigger picture, Firefly isn't just winning one-off launch contracts anymore.
No.
They are embedding themselves as foundational partners in the Space Force's defense infrastructure.
And NASA's moon base initiative.
Exactly. They are becoming indispensable.
But wait, if they're making all this money in spacecraft and software, why even bother with rockets?
Launch control?
Right, because the launch revenue is only $9.4 million. It's tiny.
It is tiny right now, but having your own rocket means you control your own destiny. You don't have to wait in a competitor's backlog for 3 years to get your high-margin spacecraft into orbit.
You just launch it yourself.
Right. And you can sell bundled end-to-end services, which is exactly why Lockheed Martin just extended their multi-launch agreement with Firefly through 2031.
Which covers up to 25 launches, right?
Yes.
So what is the actual cadence for those launches?
Well, they're targeting 3 Alpha launches in 2026,
Okay.
with Flight 8 scheduled for Q4.
And what about the bigger rocket, the Eclipse medium lift?
That's further out. They made it clear the maiden flight for Eclipse will be no earlier than 2027.
Got it. So in the near term, the revenue story is heavily reliant on spacecraft solutions.
Completely.
So how is Wall Street digesting all this?
Analysts are generally maintaining a moderate buy-to-buy consensus.
But the price targets are kind of all over the place, right?
Very wide range.
Yeah.
You've got the low end sitting around $25.
Right.
And then a street high target of $65.
Wow, that's a massive spread.
It is. The average is hovering around $36 to $41.
Which still implies substantial upside from the mid-20s where it's trading now. So I guess this leaves us with a really provocative final thought to mull over.
Yeah.
Given that 92% of their Q2 revenue came from spacecraft solutions, is the market mispricing Firefly by valuing it with the risk profile of a rocket launch startup?
That's a great question.
Right. When you look at the financials, it shows they've actually transformed into an established, milestone-driven defense and space hardware prime.
And the market might just be lagging behind that reality.
Exactly. Something to think about. Make sure to follow the show for daily earnings coverage